Hey, good morning, David.
Hi, Andrew. Good to see you.
Coffee, no fun.
Spot on. Thank you. Lovely.
David, thanks so much for meeting up with me. We met not so long ago. We had a really interesting conversation. We covered a number of issues which, frankly, I've been thinking about and have raised a few questions in my mind's eye.
Good.
Wanted to follow up with you. Last time we spoke, there were a couple of sort of key takeouts. First was that advisory firms and discretionary investment fund managers have certain obligations and responsibilities to ensure that the services that get provided to retail clients, retail investors, that they can be deemed appropriate and suitable.
Yep.
The next headline was the actual nature of who assumed responsibility in terms of meeting the suitability criteria really depended on the business relationship that was formed.
That's right.
And in that conversation, you spoke about 4 broad types.
That's right. 4 broad operating frameworks. Correct.
And depending on which model was selected would determine who was responsible in terms of suitability criteria.
That's right. So both parties will have obligations to the same client, but there'll be different obligations depending upon that operating framework and the processes in place.
So that got me thinking, and I guess sort of digging into the weeds. They say that the devil's in the detail. Perhaps in this case it's the angels that are there. But in order to establish what sort of relationship is going to emerge, but perhaps more importantly to establish who is responsible for what, where does risk lie, where does obligation lie, where are the issues, I guess there's a degree of due diligence that's required.
Absolutely. There's a high degree of due diligence, and in particular it's in the qualitative research due diligence rather than what the industry is more familiar with, which is the quantitative, the number crunching that is provided by a number of very good providers in the marketplace. So when we look at research and due diligence from the qualitative nature, we have to go back to basics, really, back to stage 1, because it's not an area that the industry itself is familiar with. You'll know there's an awful lot of noise and a lot of confusion around this area. Mm-hmm. And it's largely as a result of we've moved out of a product orientated distribution channel into a service orientated industry now. So the advisor is responsible for devising the service that they want to deliver to their clients. They go out and find their clients. They're the ones that are inviting the discretionary investment manager in. So therefore there's a great onus on the advisor now to actually conduct this research and due diligence based upon the qualitative assessments. Now, what we need to do here is to start from the basis of what is it that the advisor is looking to achieve. The challenge being that you can be very clever and you can ask a myriad of questions and create just an never-ending list of questions. But the question that then poses is, what do you achieve by doing that? You have to think about what it is you want to achieve, and therefore what is the information that you're looking to gather in respect of research and due diligence. And the best analogy that I can think of is one of recruitment. So Andrew, if you and I were in business, we're both flat out, we recognise that we could use our time more constructively, so wouldn't it be good to have somebody come in and run a specific role for us? The procedure we would go through would be something like, first of all, we've identified the needs, that's the starting point. We would look at a job description that outlines exactly what we want that person to do. We'd do a person specification. And from here, we're clear on what it is that we're looking to get. We'd go to the market in some way, shape or form, either advertise or we'd get a headhunter in, get paper-based documents in, which would be CVs, application forms. We would have a look through those, identify who looks the best fit for the job description and the person specification. We'd interview them, those that we like we do further research on, possibly ask them to do 1 or 2 tests to check them out. Then we put in place an employment contract of employment, so we engage them, and then we manage them and monitor their performance. Now, that is exactly the process that reflects the research and due diligence that is required by an advisor firm when researching and doing due diligence on a discretionary investment manager. But what it does entail, the one big difference, is the contract of employment. Where does that come from in this arrangement? Is it the intermediary agreement from the discretionary investment manager? Does it meet the requirements? Now, there's a challenge in this because these documents designed by the DIMs to give the protection of the DIM. So does it actually accurately reflect what it is that the DIM is trying to achieve? So to put all that into perspective, yes, it's a very important part. It's wasting an awful lot of time on behalf of the DIMs and the advisors at the moment because it's a new area that the industry's got to get to grips with. And I have no doubts that we can, as an industry, if we got together, we could actually make things a lot easier, but still allow the important aspect of the thinking and the application of the information. And that's the important part. Not just information gathering, but the application of that information.
So let me drill into a little bit of detail because you've covered quite a lot of ground there. First and foremost, what are some of these qualitative elements that would form part of a due diligence exercise?
Well, we could start off by being clear on who is responsible for what in the process. So where do you go to actually find out who is responsible for that? Well, that means digging into the intermediary agreements, possibly a discussion in order to understand. So if you could have a document that clearly laid out the journey the client goes on, what the advisor is responsible for, what the DIM is responsible for, where there is a sharing of information, where the interface actually comes together, then you start to pull out these obligations, which then leads to making sure that you've got the appropriate controls and oversight in place to monitor the various risks that will be coming out of those obligations.
It sounds like the due diligence is being done from the advisor onto the discretionary investment fund manager. Doesn't it also play back the other way? Doesn't the discretionary investment fund manager, to ensure that their suitability criteria are sufficiently satisfied,
Absolutely,
that they're doing a due diligence on the advisor as well?
Yeah. So again, going back to which operating framework that you're working with, if the discretionary investment manager is happy to receive a lot of the client information from the advisor, then it's clear that the discretionary manager here, in this case, needs to ensure that they are comfortable with the process that the advisor takes the client through is sufficiently robust, that the information that they're getting meets their requirements as well. So not in the legal concept of partnership, but it's two entities working closely together as a team to ensure that the outcome for the client meets the expectations.
You used the word qualitative, and I appreciate that there are elements that can't be put into numbers, but is there a quantitative part to this due diligence process?
Oh, absolutely. So in my analogy, when you're looking at external references in the recruitment procedure, clearly it's very important that DIMs can provide track records of demonstrating how they performed in various market scenarios, so that the advisor will get a feel not only of a track record that is substantial and good, but also that it meets how they work with their clients and their financial planning. So they get some idea of how they're likely to perform going forwards in different market situations as well.
So let me distill this just a little, because the word due diligence could mean different things to different folk, and I guess it also depends on where you sit in the value chain.
Yeah.
But what are some of the headline elements that should be in any best practice due diligence questionnaire?
Well, the thing the advisor's got to be thinking about is, what are they going to do with the information once they get it? So there's going to be standard information that comes about. So just general things about the company, the background, a little bit about the history and the people. So that's sort of general information. But the qualitative detail that you need to get into is some form of service of schedules, so that you can see who's responsible for what. You want to drill down into the detail of charges and fees, so that you can actually see exactly what the client is going to be paying when looking for this service. You're going to need to look at some of the operational side of the way the DIM works, to make sure that when the advisor is doing various things, such as wants to raise cash for the client, how does that work? Because that will be different depending upon what platforms you're operating on. So there's a lot of commonality, but there's also very specific areas that you would need to be picking up for each of these operating frameworks, and that really is the key to pick out.
So one of the questions, or one of the issues that I've picked up in some of my conversations with various discretionary managers is that they're asked to respond to an RFI from an advisor. And again, let's be clear, a large percentage of the funds that discretionary managers would then manage on behalf of the ultimate retail client would come through the advisor channel. That there seem to be lots of different questionnaires or different RFIs that come out, some very broad, some very deep. Isn't there a need for there to be some sort of standards-based or some sort of standards-based system that could be applied?
Yeah, there is, without any shadow of a doubt, there is a lot of noise in the industry about what is required in this area. Because it's relatively new, people aren't clear on what is required. So I think that there is a great need for some leadership here from, say, a trade body to start to give some good practice on what should be included. Now, if such a document were to come out, the key thing is it's not a tick box exercise. It must never be seen to be something that you just get completed and put in a drawer and forget about. The information that is provided is critical to how obligations are fulfilled to the eventual client. And should we ever get to the worst case scenario of something going wrong, this is where it all starts to come out and problems arise. So it is essential that key information is provided. That information is then acted on. I think the key thing is information is not knowledge. It's the application of that information in the business practice, which is what we're talking about. And we know that the regulator is looking at controls and oversight to ensure that the risks are managed properly.
But is that not then the role of the regulator to be very clear as to what the minimum standards for this type of due diligence should be?
Well, it's a very good point, and I think the regulators made it absolutely clear that everything you must do must be client-centric. We're back to our original discussion. Everything needs to be suitable for that client. So all the research and due diligence processes need to ensure that the controls, oversight, whatever you've got in place is ensuring that your process flows through to the client getting the most suitable solution.
But David, how long is a piece of string?
Well, so we're back to this point that if you approach due diligence from the point of view of the more questions I ask, the better I've done due diligence, you're starting from the wrong point. The starting point has to be, what is it an advisor is striving to achieve when working with another entity, in this case a discretionary investment manager? Be very clear, understand which of those operating frameworks meet with your requirements. From there will be specific issues that come out that need to be clear, and from that you can then put in place your own operating procedures of how the two entities work together. And I think this is the point, that if a trade body could come up with some guidance on what does good look like in that area, we could then move forward as an industry, helping both the DIM and the advisor understand those core component parts, and from there build upon this to make it a solid framework for the operating procedures, whichever one they choose, but for a DIM and advisor to work together on a sound foundation.
It sounds to me, if I can paraphrase, that discretionary managers, advisory firms together have to begin with the end in mind.
Correct.
What is it that they're trying to achieve for the ultimate retail client?
Correct.
The due diligence that you've spoken about here almost sounds like it's a one-time event. In other words,
no.
I do this up front.
Yeah.
I collect I serve as my customer. I pull the fact file together.
Yeah.
But does this carry on?
Can I? Yes. The thing being that if you've established at outset what your key criteria is, it means that you can then review that on a basis to be agreed. Let's just call it annually. That might be too frequent, but you can reassess. So first and foremost, has your criteria changed? Has your business evolved? Have you gone into different markets? You've got different requirements. But you've got a document now that is the starting point against which you assess. The next point then is anything changed from regulatory, legal point of view that has an impact on that? And indeed, has the discretionary investment manager changed? We've gone through a lot of mergers and acquisitions. They change their approach, their investment style, how they want to work with advisors. So this is an ongoing process. But if you get it right at outset, when you do your review, you know what you're comparing it against, you know what you're looking for, and it becomes a much more straightforward exercise. Should you pick up something that has drastically changed, then of course you can do something about it. But it is an ongoing process.
And presumably there's a feedback loop back to the retail client themselves to ensure that what we're doing the due diligence on up front and throughout the life of that client relationship is still relevant.
I think there's feedback in the sense that clients would expect this all to be done anyway. Why would they not expect it to be done?
Sure.
So there is an element that is taken for granted, but I think there's also an element that needs to be presented to the client, because you're, as the advisor, you're demonstrating what's going on behind the scenes when they're not seeing you working, to ensure that they're getting the right result. So I think there's something that has to be there that says, a document that says, look, this is what we're responsible for, this is what we've done. Doesn't need to be complicated at all. And it's just part of the client pack that just confirms, so that they understand why they're paying the advisor for what they're doing and why they're paying the discretionary investment manager for their role.
I guess over time, the needs of the retail investor may well change too.
Correct.
So what was suitable today may not necessarily be suitable at some point in the future.
So back to suitability, absolutely. So in the annual review with the client, which you have to have the annual review to keep up to date with everything that's going on. Of course, at that stage, you might recognise that, for example, they want to go into drawdown. And it might be that the discretionary investment manager that they're with at that time might not be the appropriate discretionary investment manager to run a drawdown process. So, of course, these are an example of where things might well change. Performance may have not been up to scratch. So again, there's a chance that you can review and have a look. Not suggesting that you're going to change on an annual basis, but understanding that you need to set the client's expectations of what is likely to be happening going forwards, as well as reviewing what's happened over the previous period.
David, thank you so much for your time.
Andrew, thank you.
Bye-bye.
Bye now.